This video is for educational purposes only and not financial advice. CoreWeave has quickly become one of the most important infrastructure providers in the AI ecosystem. The company has already secured over $66 billion in contracted revenue, working with major players like OpenAI, Microsoft, and Meta. That level of demand is not speculative, it's already locked in. To understand why CoreWeave matters, you have to look at how AI actually works. Training and running AI models requires massive computing power, far beyond what most companies can build on their own. CoreWeave provides that compute at scale, acting as the engine that powers AI workloads behind the scenes. CoreWeave actually started as a crypto mining company, using GPUs to mine Ethereum. When crypto declined, they didn't shut down, they pivoted, repurposing that same GPU infrastructure for AI workloads. That pivot turned out to be perfectly timed. As AI demand exploded, CoreWeave already had large-scale GPU infrastructure in place, allowing it to quickly become a key provider of compute for AI companies. To really understand CoreWeave, it helps to think of it as a three-layer stack. At the bottom is infrastructure, the GPUs and data centers that generate revenue today. On top of that is the platform layer, which connects everything and makes it usable. And at the top is the software layer, which is still early, but could drive higher margins over time. Infrastructure is where CoreWeave actually makes money today. The company buys large amounts of GPUs, builds data centers, and rents the compute to customers. These are often long-term contracts, which is why CoreWeave already has tens of billions in backlog. So while the business is capital-intensive, the demand is already visible. But infrastructure alone isn't enough, it needs to be usable. That's where the platform layer comes in. It connects compute, storage, and networking into a single system, allowing customers to train and run AI models efficiently. This layer doesn't generate much standalone revenue, but it improves performance and increases customer stickiness. And then there's the top layer, which is still developing. The software layer is where CoreWeave is starting to move up the value chain. Through tools like weights and biases, it supports model training, tracking, and optimization. Today, this isn't a major revenue driver, but over time, it could help improve margins and create a more complete AI ecosystem. So how does CoreWeave actually make money? At a high level, it provides GPU compute to customers, either on a usage basis or through long-term contracts. Many customers reserve capacity for years in advance, which gives CoreWeave strong revenue visibility. And as those customers scale their AI workloads, their usage and spending continues to grow. Now let's look at the numbers, because this is where things get interesting. Revenue has exploded, from a few $100 million to over $5 billion. And management expects around $12 to $13 billion next year, with a potential run rate of $30 billion after that. But here's the catch: the company is not profitable yet. Free cash flow is deeply negative. Why? Because CoreWeave is spending billions on GPUs, data centers, and power infrastructure. This is a classic infrastructure model. You build first and monetize later. Analysts are generally bullish but not fully aligned. Price targets range widely because the opportunity is huge, but execution is still uncertain. The stock itself has been very volatile. After IPO, it surged quickly, then corrected sharply. And now it's trading in a range as the market waits for execution. The investment scorecard for CoreWeave highlights strengths like market opportunity and revenue growth, alongside weaknesses such as financial position and execution risk. Opportunities and threats are carefully balanced to inform investment decisions. CoreWeave's key growth drivers include explosive AI compute demand, a substantial revenue backlog, and deep integration with NVIDIA. These elements, along with rapid infrastructure expansion, position CoreWeave for continued success. Still, this is not a risk-free story. There are real challenges: heavy debt and interest costs, massive capital requirements, execution risk in scaling infrastructure, and one more important factor: CoreWeave depends heavily on NVIDIA for GPUs, which is both a strength and a risk. CoreWeave's investment outlook hinges on its ability to operate at scale, manage capital-intensive growth, and strategically position itself within the AI infrastructure market. These factors are key to its potential profitability. So the story comes down to this: bull case versus bear case. The bull case: massive AI demand, strong contracts, explosive growth potential. The bear case: capital intensity, debt, execution risk. So here's the real takeaway. CoreWeave is not a typical tech company. It's an infrastructure play on AI. If AI demand continues to grow, CoreWeave could scale into one of the key players in the ecosystem. But the real question is not whether demand exists, but how efficiently CoreWeave can scale to meet it. Visit AIStocksHub.com for detailed reports on emerging AI companies, offering insights into the dynamic world of AI stock investments.